Go.
I bet if you've been in the markets for a little while, you probably, when we were in the midst of a just trending quiet bull market, people used to say the VIX is broken. And it's not broken. And we have someone who has a fix on it, Jim Carroll. Welcome to TradeGateHub. Is this your first time here at TGH with me, Jim?
It is, Dale. It
All right.
is.
Well, I appreciate you coming on this channel. And, we talk about the VIX, and it's very complicated. It's more complicated than most people think, where they just follow the VIX. You follow all the term structures and you have your own VIXometer. But before we get into that, I'd like to know a little bit about your history. You told me about Carroll Canyon in San Diego, but I'm wondering, like perhaps back in the university, or even earlier when you thought Vicks was something your mom rubbed on your chest and put a hot compress on top of it. Uh, what were you thinking and what drew you into this?
Oh, Vicks Vapor Rub.
Yeah. You could use it for an icon now.
Well, it's actually kind of a long and convoluted story, but I'll try to pull a thread through it. Um, I was the son of a career Army officer, so I was born in Queens, New York, and we left before I was a year old, and moved literally every 4 years while I was growing up. Uh, I actually got lucky. I have two older sisters for whom the moves became disruptive. They were in high school, college.
Yeah.
I got lucky. My dad retired just as I was going to high school and moved us back to San Diego, which is where he had grown up. And so I did high school in San Diego. Um, Actually left San Diego County to go to college. I think I'm the only one in my high school class who actually left San Diego. Why would you leave?
Yeah, exactly. Where'd you
Um,
go? Where'd you
I
go?
went to, I just went up the street to Claremont, what is now called Claremont McKenna
Oh,
College.
okay.
Great small little school, part of the five Claremont colleges out east of Los Angeles in the foothills. And so again, son of an Army guy who in his retirement taught high school for a while. I didn't know much about much, I had a couple of jobs. Um, and actually paid my way through school with an Army ROTC scholarship. I was not prepared to go to West Point and get beat up the way I assumed they were going to beat people up. But I did have the Army foot the bill for college. And so after college, I had a job. I didn't have to worry about it. But I started studying economics, and my professor said, let's talk about some of the basics. We assume rational behavior. I had a problem right from the get-go. I said, I don't know who he hangs out with, but it's nobody I know. So I decided to study irrational behavior and became a psychology major. Um,
Wow.
and I
Wow.
think that has served me well in the long run.
Yeah,
It's nice to
definitely.
understand economic theory. It's even better to understand human behavior. It may be one of the last sources of enduring arbitrage in the markets that we'll come back to talk about. So I wound up going to business school because I figured I needed to make a pivot after 4 years in the Army with a psychology degree. Was super lucky, got into Harvard Business School, found out on the second day that it was because I was ex-Army. They love ex-military people because we've already been trained to be leaders, which is what they're trying to spew out into the world. Um, and it was there that I bumped into all these people who had had jobs on Wall Street after they got out of college. I'm like, okay, what's this whole Wall Street thing? And I like to say that getting a job on Wall Street sounded like the dumbest thing that I could do, so I did it. Um, Actually started on the investment banking side of the street. Um, Worked at three firms that no longer exist. If you've been around long enough, they all disappear. I worked at Smith Barney, Kidder Peabody,
Sure.
and Bear Stearns. May they all rest in peace. And no, I was not the person responsible for their untimely demise. But that's just kind of how it worked out.
Yeah.
And it
The
was actually
Baton
coming
Death
out of
March. The
yeah,
internet caused Baton Death March.
It
Yeah.
was, well, and it was actually coming out of the internet collapse that some friends asked me if I managed money. And I had been doing it for myself, as I went along and began to save a few bucks. Um, and I thought, hey, why not? How hard can
Yeah.
it be? So I literally launched a one-man registered investment advisor. Um, and that's what I've been doing ever since. That has morphed into a relationship with the crew at Ballast Rock, the firm that I'm currently affiliated with, and we're having a great time. And now, in terms of how I landed on this whole volatility thing, it's kind of another cute story. I go back to 2015,
Okay.
um, and in 2015, all of the gurus were saying, "Wow, the stock market's expensive. Multiples are really high. Schiller PE, Vanguard, research affiliates, all the people who published GMO, all the people who published, forward-looking return estimates were saying, geez, the 10-year returns aren't going to be that great. Meanwhile, the bond market was edging ever lower and lower in terms of interest rates. So the outlook for bonds was not so great either. I'm like, holy crap, what am I going to do? I got to find something else. I had seen all the work that people had done on commodities as a portfolio diversifier, and I looked at all the data and I said, well, I think I understand why they're a good diversifier because every once in a while they lose a shit ton of money. Pardon my French.
Okay.
And that doesn't sound great to me. I want something that makes money, but maybe makes money in a less correlated way. And I came across some research around the VIX and volatility. And coming out of the global financial crisis, Wall Street, and Wall Street exists to serve the people, right? So they invented these
Right.
volatility exchange traded products. You could go long volatility, you could go
To
short
serve the people
volatility.
on the floor.
We they serve the market makers.
Yes.
Let's come up with some toys for retail to play with and churn some commissions. But I did what I have done in a lot of different areas. I basically went down the rabbit hole. I followed the Mad Hatter down the volatility rabbit hole, read all the research that I could find. At the time, there were several online resources, guys who had trading systems for these volatility exchange traded products, strategies, algorithms, rules. Um, and long story short, I found a set of rules that made sense to me. And, so that's a little more than 10 years ago, and I've been fussing around with it ever since. I do trade a volatility strategy on a small scale for a handful of clients and myself. Um, and there the VIXologist on Twitter was born out of all that work. I
Yeah.
thought, why not get in there and mix it up with people smarter than I am? I will say that X/Twitter has been a great resource for me in terms of meeting people, some of whom I still
Yeah.
haven't met in real life,
Yeah.
but it has been. I think if you treat it properly and if you don't get carried away with all the mayhem and mischief online, you can learn a lot and find some like-minded people, and that's certainly been the case for me.
Yeah.
Um,
So I found you,
so
Jim.
yeah, and so the vixologist led to me saying, it might help some people if I put some of this stuff out on a regular basis, not just in tweets. And I was actually contacted by the people at Substack. They said, "Hey, you've got some great content on Twitter. How about you bring it over to Substack?" And a little over a year ago, Vixology was born as a Substack, and I've been doing that virtually every day since. Out there with something. And I said, okay, what's the catch? What's the headline? And I said, maybe if I aggregate all of these different things I look at every day
Yeah.
and come up with a composite score, a gauge, that might be useful. So I came up with the VIX mix, as this composite gauge of volatility sentiment. And I think it has been useful. I mean, I've gotten good feedback. It's not a trading system per se. It's kind of a weather. It's a picture of the weather, and if the weather's crappy and the market's doing okay, maybe there's a disconnect there. If the market's doing crappy and the VIX mix says, the worst is over, maybe that's useful. So,
Well, it's
that's the
useful, Jim. I've seen your tweets where you're seeing some undercurrents that you're recognizing in the VIX, and you'll put out, well, at least take something, at least raise a little cash,
yeah,
you're not,
or just pay attention.
yeah, so you do, you're a watchman for this FinTwit community because of your VIX work. And I think you help a lot of people when the markets might be setting up for turbulence, and also when you get um, volatility peaks. You're pretty good at timing when it's would be great to write vol, to sell vol. So I know you brought a presentation, and I'd like to move forward with it.
Great.
Just before we do, um, what's your vibe on the market here, Jim?
Well, my vibe on the market is, and it's actually, in my little slide deck, we
Okay,
get to it. But the short version is that in 2026, the market, whether it's the Dow, the S&P, not so much the Nasdaq, but equities have behaved reasonably well. They've been making some
yeah,
new all-time highs,
yeah,
but that behavior is not being confirmed by the VIX mix. It's not being confirmed the way various components are behaving. We've seen just the VIX itself from the beginning of the year really bottomed out right at the end of 2025, and it's just kind of been moseying a little higher ever since. Higher highs and higher lows. Does that mean we're in for some epic collapse? Not necessarily, but what it says is, um, people are not all in on these recent all-time highs. People are nervous about it, and maybe that's just because we've got an administration that likes to throw Molotov cocktails. We've got, potential geopolitical unrest in different corners of the earth.
yeah.
I think some people are concerned that the consumer is not as healthy as, some of the statistics would suggest. Whatever the reason is, it's clear to me that people are uh, doing various things to protect themselves, to hedge,
Okay, well,
they're not,
yeah.
blindly all in on the equity markets.
All right.
And part of
So,
that is part of that's a rotation as well, as you know,
oh my
you know,
God, people think that if they sell something, it's illegal to go to cash. You have to replace it with something else. And I'm curious if you could recall. I mean, we're a stone's throw away from new all-time highs in the
right.
S&Ps. The Dow made new all-time highs.
Yep.
What is the highest number that you've seen the VIX be at for a market peak, not the highest number when we're into a sell-off? So we're
Yeah.
trading what, about 1920, and the recent lows were 13. Yet if we make a new high here in the next couple days or weeks, we're not going to see 13 again.
No, not in a hurry.
Yeah.
And it can get, you mentioned at the top that some of this stuff is a little complicated, and people do need to remember that the VIX is calculated using a full strip of S&P put and call options. So there are times, if we go back to the meme stock craze, where VIX can be going up in part because people are bidding the call side. We can have big call
Okay.
skew, and that can cause VIX to go up. But I don't see that in this current environment. It really is, I think people are just a little more concerned with the downside potential than with, than chasing the upside.
Well, that's a change because I remember hearing people say it's really a waste of money to put on any hedges. All they do is expire.
Well, and the reality is, you know, like buying insurance on your car, your home, your
Yeah.
life,
You don't want to
nobody
collect.
really loves making those payments, and you don't,
Yeah.
and yeah, and so it's money out the door that you feel you're obligated to pay. And I think there are some people who say, look, I'm going to budget a certain amount of money for hedges. And I'm going to accept that the vast majority of the time, those hedges aren't going to pay off. Um, look, the crazy thing is that a lot of those same people, when the hedges do work for them, don't necessarily know how to monetize them. And if you
They
hang on
they
to
don't
that,
they don't book them. They
yeah,
just hold them.
if you hang on to that hedge too long, it will start to vaporize, as quickly as it grew. So, even if you
It's a
get
great
some of the
point.
hedging right, you have to have a strategy for monetizing.
Yeah, you still
And
need to
and look,
exit. You still need
yeah,
to sell. No
yeah,
matter what you're in, it's all paper until you realize it.
yes, yeah.
Okay. All right, let's see what you got for us today, Jimmy.
Let me try to dial it up here. All right, can you see my
Yep,
slides?
got it.
Okay, so I'll try to go through this pretty quickly and stop me where you think you want to stop me.
Okay, not
So I'm
bashful.
basically part of this is looking back. Oh, disclaimer, read it,
Yeah.
memorize it. So part of this is just a quick 2025 recap, right? The tariff tantrum seems like it was so long. I mean, it is. It's almost a year ago.
Yeah.
Um, but the tariff tantrum was a giant volatility eruption. It actually led to a steep decline in volatility. Once the taco was
Yeah.
the taco trade, and there were smaller little tantrums in October and November.
The uh
Um,
the first one that you had up there, the first volatility, was that on the unwind of the carry trade in August 2024?
Well, that was 2024,
Yeah.
and yes, yes. Yeah,
Okay.
the sharp spike in August was eclipsed, and
Yeah.
I'll just let's go. Here's the chart going all the way back to 2020.
Yeah.
Yeah, you can see that the green uptick is higher than the blue uptick. The blue uptick was the July 2024, and the green is 2025. So you can see that the tariff tantrum, and obviously the spike in July, August 2024 was very, very brief. The tariff tantrum, had an eruption followed by a bigger eruption. But again, it didn't last very long. This is, a closer look at 2025 and what that looked like. Obviously, a peak in the VIX tends to correspond with a low for S&P. Um, and, we saw that. If you look at the high, low, and average for VIX, what was interesting about 2025 is that, your high was higher, your low was slightly higher. The range was much wider than it was in 2024. And in fact, the
For
range was
years.
wider than any year since 2020.
Yeah.
So,
And we know
from
what
top to
happened there.
bottom,
Yeah.
yeah, from top to bottom, it was, a wide range. Um, and the other thing we saw, when people talk about the VIX being broken, well, this chart, which is not one that a lot of people necessarily take a look at every once in a while, it's mapping the average change in VIX measured in points for every 1% change in S&P. So if you look back at 2022, you can see kind of small bars, the
Yeah.
VIX was not, overreacting, but that has, stair-stepped higher for 23, 24, and 25. So, the VIX is definitely responding to changes in the S&P. Again, not as much as it did in 2021, but it's definitely been responsive.
Okay.
This is just a quick look at, the SIBO term structure, VIX 9-day, VIX 3M, 6M, and 1 year, highlighting where it went at the peak of the tariff tantrum. But then by year end, we were down below what the trailing 12-month average looked like. So we ended the year, in a pretty calm state. I mean, VIX was below 14 at the end of the year. So, a pretty stark comparison to what it was in April. Going to the VIX futures, this is, a constant maturity VIX future that we calculate so that it's more comparable to the spot VIX. Similar, look, a slightly wider range, a slightly higher average. 2025, whether it's VIX or the VIX futures, was definitely a year where there was some action. And at the peak of the tariff tantrum, this is interesting. The tradable VIX futures, the green line, showed less fear than the SIBO volatility indices themselves. It can be the case. It's not unusual to see more volatility in the options market, which is where the VIX comes from, than you see in the VIX futures, which are tradable. And that's certainly what we saw at that peak of the tariff tantrum back in April. And when you see this, it's not unlike what we saw on that on that August day in 2024, where the VIX, blew out the top, but the VIX futures didn't chase it. It was basically saying that the option market was reacting much more strongly than the futures were. And from my standpoint, I pay more attention to the futures than I
Okay,
do,
that's interesting.
the
So you
so-called
you you
cash
get you
indices.
get your market tells from the futures
You uh,
rather
you
than the
often
options.
you often will get a market tell from comparing how the futures are trading relative to, the spot numbers.
Okay, that's a pearl.
So so the other one of the other things I look at in the term structure is, backwardation and contango. And, we can get into an argument about, how you measure contango and backwardation, but this is a simple way. If the front month futures are above the second month futures, I call that backwardation. And what's interesting in 24 and 25 was that you had most of the backwardation in the back half of 2024, and you had most of the backwardation in the front half of 2025. So you had basically a 12-month period from mid 24 to mid 25 where, all the mayhem was happening. And, coming into that front half of 2024 and the back half of 2025, things calmed down and the term structure was in contango most of the time. And frankly, it's in contango most of the time, right? But it was interesting that we had this 12-month period where, there was a lot of stuff going on, sandwiched in between two periods that were relatively calm.
So is that really an important thing to pay attention to, that when we move from contango into backwardation, that there's a transition and basically the reverse. We go from
Yeah.
backwardation back to contango. It'd be a better time to sell vol
Yeah.
than if we're in backwardation.
Yes. Yeah. And one thing I suggest to people is, if you have a short vol position, and you can express that in a bunch of different ways. You could be long S&P, and that's short volatility. You could buy SVIX, which is a short vol ETF. Don't wait to get out of that position. Don't wait for backwardation to get out of that position, because it may be too late. What happens is you start to see the term structure flatten out. If it's in contango, it will be flat before it goes backward.
Right.
So you really do need to monitor the conditions and say, my odds of this continuing to work for me have gone down significantly. I don't think I'm going to wait, for the fire engine
Right.
to show up before I get out of my position. And so, monitoring contango and backwardation, but really monitoring the slope of the VIX futures term structure. And I'll come back to that as well.
Okay.
So the VIX mix, it was introduced in 2024, 17 component indicators at the moment. I'm considering whether there's some others that might be included. And, really for me, it's not so much a, market timing, buy today, sell tomorrow kind of thing. But it does kind of give a sense of what the weather is and the extent to which, as we discussed earlier, it's either in sync with the market or diverging from the market. In either case, kind of adding some perspective. And again, it could be that, the S&P has been in a nosedive and, you wake up one day and the volatility measures have improved in advance of S&P coming off the bottom. And when
Okay.
volatility
So,
gets better while the S&P is making a lower low, it's kind of a wake up time to say, maybe the worst is over.
are there any parallels or correlations to the greedometer? You ever pay attention to
Fear
that,
and
Jim?
greed. Yeah.
Yeah,
Yeah. And I think there are several different gauges out there of sentiment that use different um, components. But there definitely is, sort of a fear and greed, and excessive fear tends to be the mark of a bottom.
right.
Excessive greed can be, not necessarily. It's like overbought and oversold.
Yeah, go on
I
forever.
find, yeah, I find oversold to be a little more reliable than overbought, right? Because the equity market has an upward bias. So things can definitely stay overbought longer than you want. They tend, when they get really oversold, there is a tendency to, see some improvement. And, fear and greed are similar. The greed can last a long time. The fear tends to find a crescendo, and then, it doesn't mean you're going to have a V-shaped recovery. Um, but it may suggest that if you've had some hedges on, it might be a good time to close them out.
Okay.
So this is a picture of the VIX mix in 2025, and what's interesting is if you go back to February when the S&P, and this doesn't go all the way back, but the S&P was making highs in January, February of 2025. And the VIX mix couldn't get green. It was suggesting to me that again, people were not completely behind the move higher. Um, you know, it bottomed basically when the S&P did and started to march higher. It's really the improvement. It doesn't have to turn green to be a buy signal. It can just be less red or less yellow. Um, and again, in the fall, the where we had decent pullbacks in October and November, it never got well. It got green for a couple of seconds,
Yeah.
in late October, but didn't last long. So again,
Are
it's
we
it's kind
are
of
are we
go
still
ahead.
all green here, Jim? In
No,
February?
we'll come back. We'll come
Okay.
back because we haven't been green in a while.
Yeah. Okay.
Yeah, so let
Interesting.
me move through this. This is just showing,
That's
the
really
S&P
I
was,
love that.
S&P was a new high, but the VIX mix was not bullish.
Yeah.
VIX mix was less bearish on the late April pullback. A new high for SPX. VIX mix says, same thing. So,
So
it can be useful just
you
as
get
kind of,
divergences between price and VIX mix.
yeah, and divergences can last a while, but at least you're paying attention. That's all I suggest people do. So what? You know, Long-term investors can choose to ignore volatility or use it to their advantage. Avoid flying blind, identify potentially vulnerable conditions, look for oversold conditions when fresh capital might be deployed. I say, look, if you're a buy and hold investor, then maybe you don't care about this stuff, but maybe you just want to kind of get your mind right. If we're flying along and all of a sudden, you hit an air pocket, you might at least want to, um, you know, not panic. If you see it coming, you can respond. You can say, I see it coming. I don't care. I'm okay. I'm inside my risk tolerance. That's fine. And on the other side, active investors, may choose a more aggressive approach. Identify opportunities to get short or go long vol. Look for rebounds to employ short vol or levered long positions. The toolkit includes, all sorts of things. Exchange traded products, levered ETFs, options, futures. They're when I first read all the Market Wizards book, the thing that struck me the most was there are 1,000 ways to make money in the markets. You got to
Yeah,
figure out the one that works for you.
exactly.
And
And
and and
the author of that book, who I've spoken to, I
yeah,
said, "What's the most important advice you could give traders, Jack?" And he said, "Find a trading style that suits your personality."
exactly. Yep.
Jack Schwager.
Yep.
Yeah.
So, this is saying, so what, what can I do about this? And this just demonstrates that a buy and hold strategy using the volatility ETFs, and here we're using SVIX and VIXI, is fundamentally flawed. Because as often as they work, the rest of the time they're killing you. If you're long vol, if you were long vol going into the temper tantrum, that was fantastic. And then it spent, the remainder of the year going straight from upper left to
Yeah.
lower right.
Yeah.
And if you were short volatility going into that period, you lost a boatload of money. So, you cannot buy and hold these things. You've got to use them as instruments for some kind of trading strategy. And frankly, most people shouldn't use them at all. Most people should just, erase the tickers from anything they have and not pay attention to them. But if you're interested, there are some things you can do. This is a look at the VIX futures term structure using two of those exchange traded products. There's an ETF called VIX-M that looks at the midterm VIX futures, and VIXI looks at the short-term VIX futures. And what I said was, maybe if I just compare those two, what's the ratio of those look like? And the ratio of those looks like the S&P 500 expressed in terms of the VIX futures term structure. And what I've highlighted here is if we go back to late February of 2025, and just looking at some simple moving average crossovers, you know, watching this measure of the term structure would have said, gee, maybe this is getting bad. Maybe I want to do something about it. Maybe I want to get long some volatility. Um, and same thing, in late April, it turned up at about the same time that the crossover on the S&P took place, and you had a very long run of where short vol was working. If you had bought SVIX on May 1st of 2025 and held it, for 6 months, you made, more than 60%. Last time I checked, that was real money for most people. So there are
Yeah.
ways to use these things in a tactical trading strategy that might be interesting for some people.
There are a lot of funds that specialize in shorting vol, aren't there? ETFs and funds.
Well, there are
Some.
there well, yeah, there are definitely some the ETFs are and yes, there's the biggest one actually is sort of a discretionary. It's a managed fund out of Simplify, ticker SVOL, that is for the most part short VIX futures, hedged with a call on the VIX. Um, you know, I'm not necessarily a huge fan because it's being managed by somebody else, and I'd rather do it myself. But it's gotten a lot of attention. It's got over 600 million of assets under management, so there are some people out there who are happy to be
Yeah.
there. Um, this is a picture of what you might have done being long volatility. And again, I'm just using a stupid, simple, kind of moving average crossover here, which is the bottom pane, that said, hey, maybe you want to buy some of this stuff uh, back in July of 2024, where we had that explosion. You could have made 65%, something like that. Pick a number because you could exit. You could say, if I make 50%, I'm out, whatever. Um, and then in the tariff tantrum,
Do you have monetary goals on trades? Like if you're and
um,
take partials, say you're up 20%, book something, let the
it
rest
it
roll.
it it depends on what kind of exposure it is.
Okay.
And what I've done, Dale, is I've looked at the history to say, if it's moving, um, what's the typical range? What's the typical time frame? So
Okay.
I've got a sense of what the possibilities might be. But I tend to let a long volatility trade work itself out.
Okay.
It tends to happen relatively quickly. Um, but you never know how long or how far. And everybody's if you put 20 volatility managers in a room and say, how do you monetize your trades? How do you exit your trades? You're going to get 20 different answers. And that's,
Sure.
that's fine. That's the art because it ain't a science.
You're right.
Um, Now, the flip side is you had a period between September and, sort of mid-February where you chopped around and, if you took trades, you were having a bunch of frustration. Um, and that's frankly, that's one of the wonderful things I like about this is that the average person and even the average professional is going to experience a string of bad trades, losing trades. They're going to get frustrated and they're going to quit. And that's fine because,
In other
that's
words, don't do this at home.
don't do this at home. Recognize that, and this, Dale, recognize that even the most successful traders in history are right maybe somewhere between 50 and 60% of the time. And so you're continually experiencing losing trades. You can go through streaks of, 5, 6, 10 trades in a row that don't work. You think I've lost my mind. Why am I doing this? And then you won't take the next one, and the next
And
one will
that'll
be the
work.
big winner.
Of
Yeah.
course. Yes.
So, this is just a perspective on how you might look at it through the lens of trying to get long these things, long volatility to benefit from these disruptions. And,
You ever hear the expression to be there for the good times? You have to be there all the time.
it makes sense. And one of my mentors says, every train looks the same leaving the station.
I
You
like
you
that.
you you can't know which trades are going to work,
Yeah,
but you gotta take it when it presents itself.
that's right.
So this is the flip side of that. What if I wanted to, be short vol, which is sort of in sync with, the equity markets. And again, sort of coming out of that taper or tariff tantrum back in April, you could have been long vol or short vol for a little while, short vol for another period of time, short vol for a period of time at the end of the year, into the new year. And last time I checked, again, if you made 12% on one and 23% on another one and 23% on another one, that can start to add up pretty nicely after a little while. But again, you've got to have a system, you've got to have a set of rules, you've got to have a discipline to be able to do this with any consistency.
What's a minimum size account you would need to trade your strategies for you to trade for someone, your vol
So,
strategies?
typically, I'm doing this in the context of a, broader client relationship where, you know, you can appreciate this as well, Dale. When people talk about risk, they say, well, Jim, if you do this, you're hedged, right? And I say, no. They say, what do you mean you're not hedged? I said, well, hedges are a drag on performance. I manage risk through, stop losses, systematic rules for trading, and position sizing.
Yeah,
Because you wouldn't want all your money in something that's as volatile as this. Uh, but you might be happy to have, I don't know, 5 or 10% of your money in something like this, especially if it could be in a retirement account. Our typical
Yeah.
client minimums are, a million plus. And so, if I've got $1 million client, we might have $50,000 allocated to something like this.
Got you.
But I'm not looking to manage somebody's $50,000 and have that be all we're doing.
I
That's not
understood.
interesting to me.
Okay.
Um, so where are we now? This is the one you wanted, Dale. This is
Yeah.
so so the S&P 500 just kind of continues to meander. It looks like a snake. Looks like a roller coaster, which is the metaphor I've been using recently. The dips have been bought, new highs have been registered, and at the same time, the volatility complex is telling us risk off. We don't like this.
Interesting.
We're not happy.
We haven't seen
Uh,
green in what, over a month or so?
we haven't seen green in more than a month,
Okay.
24 trading days.
Okay.
So, again, this is one of these monster divergences. And, maybe, because I look at this kind of sideways roller coaster in the S&P, that kind of action can't go on forever, right?
Is it
Uh,
distribution or are we going to blow off?
Well, that's a good question. There's definitely been some distribution. We've got small caps better than large
Yeah.
caps. We've got the Mag
Yeah.
7 trading off relative to the 493.
Yes.
We've got value outperforming growth. We've got international outperforming US. So there definitely is some rotation going on. The real question is, uh, this market at some point will either find its footing and move higher in a more decisive fashion, or it will roll over and, our divergence will be because the VIX mix was right and the market decides to tank. I
There'll
have
be
no idea what's going to
yeah.
happen, but I'm watching this divergence because it's troubling. It needs to resolve itself. Um, and it doesn't show any signs of getting better at the moment.
Okay.
And we've had enormous intraday volatility and enormous day-to-day volatility over the last several weeks. And that is not the kind of behavior you see in raging bull markets.
No, markets top with violence and
Yeah.
bottom in silence. And I'm looking, I'm looking at this chart and just as an observer, the highs we made in October, with all of this bullish enthusiasm, Jim,
Yeah,
I think the S&Ps are unchanged from the October high right
pretty
now.
much. Yep.
Yeah. Okay.
Yeah, pretty much.
What a great presentation, buddy.
I got a few more if you want.
Oh yeah, okay, go ahead.
Anyway, this just shows that uh, where are we now? VIX bottomed at the start of the year and is trending higher.
Yeah,
And its average true range is trending higher also, right? It's sort of day-to-day volatility is getting higher.
okay.
More importantly, because we can't trade the VIX, we can trade VIX futures though. They are trending higher again and again with some short-term volatility, but higher highs and lower lows, which does not encourage the bulls, unless you're bullish long all. Again, back to my chart of the VIX futures term structure. This is, if you look on the far right, you see these little red bars.
Yeah,
Little red bars are not a good sign for equity markets. Zooming in a little bit, again, this could resolve itself to the upside. We saw the red bars in a couple of times this year already. We saw
yeah,
them in October and November. So it
yeah.
doesn't mean we're headed for, over the waterfall, but you got to be paying attention. You can't be all in the current conditions. One thing that I was looking at and talking to some people about, under the hood of the equity market, breadth has been okay.
Yeah.
And this is just one measure looking at
That's
the,
that's what the bulls are hanging their hat on for new
yeah, and
highs.
we'll see. We'll see. It's okay. But again, I think you can't go to sleep for the next several months and expect that nothing's going to happen, that it's all going to be good.
And the
And
Nasdaq breath has been lousy compared to NYSE, right?
right, yeah, it's definitely not as good.
Yeah.
Um, So anyway, this is
Interesting.
one of the things that says, maybe this will resolve to the upside again. One of the other things that I watch that, not many people do is not just, high yield spreads, credit markets continue to be looking good from a spread standpoint. This is a very off the run statistic that Tom McClellan clued me into a bunch of years ago. If you look at advanced decline data for the high yield market, what?
Yeah.
Well, yeah, bonds trade and some trade higher and some trade lower on a day-to-day basis. Is it perfect? No, it's not perfect. But if you go back and look at the history, and this is just a snapshot of the last 5 years, stuff rolled over before we got into 2022, where the markets crapped. Things had been rolling lower in the high yield market in terms of advanced decline before the tariff tantrum showed up. We flattened out recently. We look like we're ticking back higher, which would suggest that, equity markets are going to be okay. We'll see. This is one of those things. This is what I refer to as the canary in the coal mine. And right
Yeah.
now, the canary's alive and singing, but that could change.
Okay.
And that's just me, Vixologist on X, vixology.substack.com.
Well, you know, this was a great presentation. There's a lot to dig in with, and recommend you guys follow Jim. And if looking for a more active manager or want to compare, we just finished up 2025. You're not happy, give Jim a call. I'm sure he'd love to talk to you and see what your guy has been doing and see if he could improve upon it. And especially if you're interested in this strategy that um, Jim is pretty unique in executing. So, Jim, I want to thank you for your time. You always bring a great presentation, and uh, also appreciate you having you here at this time and seeing what's happening as far as your indicators. And not a lot of green. We have a
No,
green
look,
day today. Yeah,
well, and that's just it, Dale. And even if you just look at Friday and yesterday, right?
yeah,
Friday, the end of the day, we sell off, and I'm looking at it from a vol perspective, and I see my long vol things going higher.
yeah,
And I'm thinking, okay, here we go into a 3-day weekend. Is this going to peter out over the weekend? Is this going to follow through? And yesterday, in the morning, it was following through.
right.
VIX was going higher, stocks were going lower, and then it was boom, U-turn.
Yeah.
And
Well,
so
yeah, it's been a beach ball. When
yeah,
you go you go to the ocean and you push that beach ball down, it just keeps popping up until maybe a starfish punctures it when you take it down. But Jim, really, I'm so glad our paths crossed on X, and I've learned a lot from you. And everyone, if you're interested in learning about VIX, then you should make an appointment with your VIXologist, and that's Jim Carroll. All right. Thank you, buddy.
the doctor is in.
My trading warrior brother, Jim Carroll, everyone. Have a great one, Jim.
Thank
Keep
you,
in touch,
Coach.
buddy.
Will do.